and Chief Executive Officer of Northern Arc Investment Managers Private Limited. He was previously also associated with the Standard Chartered Bank. Just a little brief about the Vivriti Capital. Vivriti Capital is a systematically important non-deposit taking, non-banking finance company. Registered with the Reserve Bank of India, it was started in June 2017 by Mr. Vivriti Kumar and Mr. Gaurav Kumar as private limited company and was recently converted to public limited company. Vivriti is backed by marquee institutional investors such as Creation Investments, Lightrock, and TVS Capital, who in addition to providing capital have also assisted in growth through strategic guidance based on the previous experience and insight into financial services sector in India. Though these marquee investors, Vivriti has raised approximately 1,300 crores in equity. Vivriti offers leading products to mid-corporates, including long-term loans, working capital demand loans, co-lending, and financial partners, securitization of receivables, supply chain finance, etc. across sector in the business of healthcare, pharma, logistics, retail, etc. Vivriti also subscribed to the bonds and commercial papers of various mid-corporates. The ticket size of these loans ranges from 10,000 to 80 crores, with an average ticket size of less than 3.5 crores. The loan tenor is determined by the profile of the borrowers and its capabilities along with the collaterals, with a tenor ranging from 1 month to 48 months. In this very short tenor, Vivriti has been conferred with various awards, including Financial Service Company of the Year Award at VC Circle Awards 2023, Top Alternative Lending Tech Startup by Trunks, Company of the Year Financial Services at Dare to Dream Award by G Business. Vivriti has also been recognized as one of the best BFSI Award 2023 by Economic Times. Talking about financials on a standalone basis, Vivriti has an asset under management over 5,800 crores, backed by the net worth which stood about 1,564 crores and borrowing of 4,766 crores. Its debt to equity ratio stood at 3.05 times as on 31st March 2023. As on 31st March 2023, Vivriti reported standalone profit after tax of 129.3 crores, which was 67.37 crores last year and 30 crores in financial year 21. Its net NPA stood minimal at 0.08%, 0.07% and negligible in financial year 2021. Further, the quarter ended June 30, 2023. As per the unaudited financial, Vivriti reported a standalone profit after tax of 51.86 crores on revenue from operations of 216 crores, while its net NPA stood at 0.15%. On the liability side, Vivriti benefits from a large and diversified mix of lenders, including more than 200 institutional lenders, investors, and 1,700 HNIs on the private placement side where they have participated. Some of the key lenders include public sector banks such like Bank of Baroda, Bank of India, Canara Bank, Bank of Maharashtra. Among the private sector banks, the banks like HDFC Bank, Axis Bank, Kotak Mahindra Bank, and IndusInd Bank has a kind of sanctioned loans to them. From the NBFC side, the lenders include Aditya Birla Finance, Tata Capital Finance, Piramal Enterprises, and SIDBI. Just to talk a little bit about the offering, the public issue of Vivriti is secured, rated, listed, renewable, non-convertible debentures. It's opening on this weekend, which is August 18, 2023, and scheduled to close on August 31st, 2023, Thursday, in the next week. However, the issuer has the option to early close the issue anytime in this period once it gets the expected subscription, subject to a minimum issue period of 3 working days, by publishing a 1 day's early closure notice in the leading newspapers. The allotment shall be on first come, first served basis. The issue is rated ICRA A stable by ICRA and CARE A positive outlook by CARE ratings. It offers NCDs under 2 tenors of 18 months and 24 months. In both the tenors, there is an option of getting interest at a periodical intervals of monthly or annual. There is a special option of 24 months wherein the investors will get the interest servicing on a quarterly basis. Apart from the interest, they will also get the principal redemption in the equal installments of 125 rupee each in every quarter. The coupon range of the instruments offering is 9.57% to 10.5% across the 5 tenors. I earnestly appeal to all our partners and investors to reach out to the maximum number of potential investors in all categories and let them have an opportunity to invest in such an attractive offering. We have allocated 30% reservation for retail individual investors who are applying in the issue for an amount of 10 lakhs and lower than that. We have also kept a reservation of 30% for the individual class of investors who are applying in the issue on application size of our 10 lakh rupee, which is HNI category. We have kept 20% reservation for each corporate and qualified institutional investors. It clearly tells us that the issue is meant for the individual investors. That's the reason they have 60% allocation and reservation for them. The individual investors holding up to 5 lakh rupee can apply through the UPI as well. I thank you for taking time out to attend this conference today. We shall look forward for your wholehearted support, as it's always been the case in the past. May I now request Mr. Vineet Sukumar to take us through the presentation and tell us a little more detailed about the company and its prospects. Thank you. Over to Vineet.
Thank you, Ajay, and a warm welcome to all our listeners. I apologize for the poor lighting. I think the lights has gone off, but it will come back on soon. I will put up a short presentation that will help us orient our discussion for the next 20 minutes or so, after which we can take questions from anyone in the audience. Right. So I'll divide the presentation into 3 parts. The first part is where I speak about our headline numbers as an organization. The second part is where I cover the business model and what is it that we represent. And the third is where I speak about the specific debenture issue itself. Starting with our headline numbers, as Ajay mentioned, we are a 6-year-old firm. We began in June 2017. Before this, I had worked with Standard Chartered and Northern Arc Capital and Northern Arc Investments. My background has been almost entirely in credit and lending. When Vivriti was started in 2017, this was a period during which we saw a significant opportunity in lending to the mid-corporate space, and that's where we have specialized. Today, as we stand, Vivriti's gross assets under management stand at just around 5,850 crores, with a capitalization of over 1,500 crores, a return on equity inching towards double digit, a very large base of lenders and investors. And in addition to this, we also have more than 1,700 HNIs who are participants in our earlier bond issuances. We are dual rated A by ICRA and CARE. We are very profitable with 130 crores of profits last year. We are well capitalized with a capital adequacy ratio of more than 25%. That is much higher than what RBI requires at 15%. And finally, icing on the cake is that our gross NPA stands at just over 0.3% as we speak. What does the group look like? The parent entity of the group is an NBFC called Vivriti Capital Limited, which is also the issuer for the proposed retail issuance. We have a wholly owned subsidiary called Vivriti Asset Management, which is essentially an asset manager that manages credit funds. And finally, we have an associate company, which is called Cred Avenue Private Limited. That is a marketplace for debt. A quick sense of the chronological order of events, of significant events in our history so far. As I mentioned, the company began in June 2017 and received its NBFC license in January 2018. In 2019 early, Creation Investments invested a little over 300 crores into our capital as our Series A round. Creation is a private equity fund based out of Chicago with an office in Bangalore. One of their earliest investments in India are Equitas, as an example. Shortly after they invested, ICRA gave us an A- rating with a stable outlook. In March 2020, just before India went into lockdown, Lightrock and then again Creation invested 350 crores and 100 crores each as part of a Series B round. We got subsequently a rating upgrade from CARE at A rating in 2021. Our first sustainability report was launched in 2022. Our Series C capital raise happened in 2022, March and May. This is when Creation and Lightrock again invested and were joined by TBS Capital in this round of a little over 600 crores into the company. Consequently, ICRA also upgraded our rating to A after this. Finally, we closed March 2023 with a 5,835 crore asset book. And in May, changed our constitution from being a private company to a public company. That's our event history. Now, what's our business model? As I mentioned earlier, when we began in June 2017, we saw a massive opportunity in mid-corporate lending. We continue to see the opportunity, which is why we are a specialist in this market. We lend to mid-corporates across a very diverse number of sectors, be it manufacturing, engineering, auto, infrastructure, retail, trading, oil and gas, mining, shipping, etc. We lend to them across a wide array of products: term loans, working capital, vendor finance, dealer finance, securitization, factoring, leasing, bonds, money market instruments, right? We lend across ticket sizes, but typically we don't go above 40 crores. Our average lending size for term loans is around 15 to 16 crores. For supply chain finance, it's around 1 crore. For co-lending, it's 1 lakh. So the weighted average across the book is 3.5 crores, which is much more than a retail finance company, but lower than a bank. The tenure of our lending, mostly we lend in the range of 18 to 24 months. The maximum can go up to 48 months, right? We are well present across the country. We've opened multiple offices in South, North, and West. We have been able to spread our wings across a large number of clients across the country and across products. So as you can see, we are not your typical NBFC that provides auto loans or home loans or MSME loans or microfinance. We lend to corporates. These corporates typically have a revenue of anywhere from 100 crores to 3,000 crores, right? And that's the category of borrower that today we are lending to, and that has determined our org structure, our presence, and our numbers so far. Now, what's important for our business is how do we make money? That comes in from the spread between our rate of lending, which is a yield, and the rate of borrowing, which is cost of funds, right? Now, our yield has been broadly stable at 14% over the last 3 years. Our cost of funds improved sharply from March 21 to March 22. Between March 22 to March 23, while repo went up by more than 200 basis points, our cost of funds went up by 24 basis points in the same period. And our spread continued to widen. So the difference between yield and cost of funds continued to widen. Our growth has been good. 3x build up in AUM between March 21 to March 23, from 1,900 crores to 5,800 crores plus. Profits have grown 4x in the same period, from 30 crores to 129 crores. Return on asset and return on equity have grown as well. So we've been able to balance scale and profitability. We have backed it by net worth. I have always kept the company well capitalized, and currently the net worth, inclusive of the capital we raised, stands at a little over 1,600 crores as of end of June. Our capital adequacy is above 26%, despite an RBI requirement of 15%. A summary of 3 years of numbers on this page here. You can see the asset book, the liability book, disbursements, income, profits, net worth, ROA, ROE, cost of borrowing, as well as capital adequacy. But I think the most important number here for you to see is the gross NPA. The gross NPA in March 21, March 22, and March 23 is 0.3%, 0.3%, and 0.3%. So we've been very consistent in maintaining a low NPA across this period, and I would think that this is amongst the lowest in the NBFC industry. Our plans and thoughts for the years ahead, while I cannot comment on any forecasts, etc., but there are 5 specific areas where we need to spend time and money and invest. First and foremost being technology. So technology for us has been an area where we have invested significantly, given that we are in enterprise lending. Most of the innovation that happened in fintech happened on the consumer lending side. We've had to start from scratch and build our stack. So we built our stack for lending, supply chain finance, credit, co-lending, etc. Secondly, investing on products. Our customer is a complex character, and therefore needs a wide variety of products, be it short-term, long-term, on-balance sheet, off-balance sheet, dollar, rupee, etc. And it's our job to cater to these different varying needs and build our own strength with the company. The third is ESG. ESG is not a buzzword for us. We've invested significantly way before this was required by any regulator or the government. We set up a proprietary ESG rating model last year, and today we work with clients to advise them on reducing their ESG risk as well. Fourthly, on liabilities, lot of work has gone into building a very diversified liability book. We borrow from public sector banks, private sector banks, foreign banks, small finance banks, mutual funds, HNIs, international investors, to ECBs, etc., etc. We borrowed across dollar and rupee. We've been able to hedge our dollar borrowing risk as well through hedging lines, and therefore we've come a long way in our ability to access debt. Finally, enhancing brand awareness, very, very important for us because we are a lender pan-India, and it's important for mid-corporates to know about us so that when they want to borrow, they can dial Vivriti. And that's why that's an area where we have to spend. We've done all this while being backed by high quality governance structure. It was very important for me early on to invest in this. Within 18 months of our starting, we brought in our first set of independents. Deloitte has been our auditor since the first year, and now more recently KPMG. Namrata, who also serves as chairperson of the board, has come in after 2 decades of experience across Grindlace and Deutsche Bank. Anita, who has again had 2.5 decades of experience, today also sits on the boards of IDFC Limited and Reddington, other than Vivriti. Shantanu is an entrepreneur, an alumnus of IIT Madras, LGT, and Creation Investments on our board. We have a strong management team with people cutting across large parts of financial services, technology, lending as well as from the legal, HR, and products functions as well. We don't have any senior hiring left. Largely, we are going to focus on building the business now, with the team having been put into place over the last several years. That brings me to the end of the section on the company. I will spend a few minutes on the issue itself, and then we can open it out for questions. As you can see from the issue structure perspective, we have aimed to make it as friendly and easy as possible for investors who would be first-time investors into bonds of Vivriti. The issue minimum ticket size is 10,000 rupees. The coupons range from 957 to 1050, which results in an effective yield of 998 to 1049. There are 5 series to give more flexibility and cater to your specific needs. So there is monthly and annual coupon payments for both the 18-month and the 24-month series. Finally, there is also series 3, where the capital will be returned over 8 quarterly installments over the life of the instrument. Right. That's it from my side. I tried to give you a good sense of the company, the issue structure, as well as the overall headline numbers and our plans for the future. Most happy to take any questions from the audience.
Thank you, Vineet. And we now open the floor for the question and answers. We have been getting some questions. I'll just start reading one by one. The first question is about what are the parameters you follow to evaluate risk involved before you lend or decide to lend?
Right. So the principle we have followed during lending is that one, it's important for us to be extremely well aware of the company and its landscape. Today, India's data architecture gives us unparalleled access to a wide variety of information. For example, today we have access to GST records, bank statements, we have access to provident fund payments, we have access to litigation that has been now digitized across multiple courts of the country. We have bureau records, we have MCA data on financials, we have related party transactions. This constitutes the company's digital footprint and ecosystem that we should be aware of. Post this, we enter into a very detailed diligence of a company, which is typically 2 full days in their office, where a 2-member team from our side goes to meet the company, understand their business thoroughly, meet their key people, meet their customers, look at project sites, and come back to create a very detailed report consisting of both the digital footprint, information from the company, and diligence observations. Because we don't want to take business model risk. We are most happy to take execution risk, but we don't want to take business model risk. Right? And that's been and these thoughts have defined our way of thinking in the lending business. Right? Now, what we do not do largely is to focus on promoter entities or non-operating entities, etc., etc. We have to be close to the cash flow. Right? Last point, it's been important for us to maintain a very diversified book with a ticket size that today has been in the range of, say, 15 crores for lending and 1 crore for supply chain, right? Because that brings a certain granularity to the book and protects us from economic down cycles. So having a relatively less correlated book with diversification has protected us all these years.
Thank you. The next question is about why there is sudden drop in revenues and profit for the year ending 31st March 2023. I don't think that's the right observation, but however, if you want to kind of answer this, you can kind of let the people know how the profits and the revenues has been scaling up over the last couple of years.
Yeah, so in the last 3 years, our revenue has gone up from 225 crores to 352 crores to 671 crores. Our profits have gone up from 30 crores to 67 crores to 129 crores. So actually, we have tripled in revenues and quadrupled in profits between March 21 to March 23.
All right. There's one question about how are you going to utilize this 500 crore rupee raise from this public issue?
Yeah, sure. So as you can appreciate, for a lending company, money is raw material, right? And money will be deployed in building our own balance sheet and growth. Today, given the market that we are in, we see a significant amount of opportunity. We are seeing opportunity across a host of sectors that either are being driven by the government's own capital expenditure or driven by government policy reforms or driven by the kind of consumption story that we are seeing in India, right? Or driven by companies maturing and coming out of the woodwork to be able to grow and scale with ambition, right? So we see multiple use cases. We are seeing a CapEx use case. We are seeing a long-term working capital use case. We are seeing a mainstreaming use case. We are seeing a growth use case. And I think we are seeing a lot of opportunity for us to be able to continue to lend, right? Now, the most of the money from this 500 crore issuance will be really going towards building our business. While we have reserved a quarter of the issuance towards general corporate purposes, but my expectation is that most of the money will go into business growth and creating more portfolios, onboarding fresh clients, etc.
Understood. The next question is about what is the level of competition Vivriti Capital Limited expect post-launch of Geo Financial Services or other NBFCs in the similar field?
Yeah. So as I was mentioning in the beginning of my presentation, the overall the market, the lending market can be divided into consumer, MSME, microfinance, auto, housing finance, mid-corporate. Now we're in mid-corporate lending. We don't lend to individuals. We don't do consumer lending. We don't do housing. We don't do MSME. We don't do microfinance. Those are not the kind of models that we work on, right? And therefore, while Geo Financial might be thinking about a business model that is more suited to data-rich fintech companies, which is essentially consumer and micro enterprise, right? That is not Vivriti Capital's business, and therefore we don't perceive Geo Financial as a competitor for us. See, not all NBFCs are alike. You have to think through an NBFC basis the sector and the customer that they engage with, right? And that will determine whether a new player will compete or not really.
Right. The next question is, can you throw us a bit more light on the 24-month quarterly payout option, how it would work?
Yeah. So the way to look at it is that, some of you might prefer to, have the money locked in for 18 to 24 months, given that interest rates are likely to start trending down, and therefore a fixed rate product at this point of time makes sense to hold on to. But having said that, we also wanted to create one option where if you wished to see your capital come back gradually over time and improve the near-term cash flows, we would have that available. So that's where Series 3 comes in. So in Series 3, an investment amount of 10,000 rupees will actually see 1,250 rupees plus interest come back every quarter, right? Over a 2-year period. So that's how we have kind of broken down the issuance into multiple series to make it very friendly for investors with varying needs.
Right. The next question is, people are asking about, can you outline the broad process of lending in personal loan segment? I don't think we are in the personal loan segment. What are the different metrics you use in terms of evaluation? And also how you do your due diligence process in different form of competition versus other companies, how do they analyze? May you please elaborate on the credit culture as to what is the team structure? Is there a categorization of loans by quality like HDFC Bank does A1, A2, A10, like that?
Sure. So first and foremost, as you rightly said, we are not in the personal lending segment. Sometimes we get into co-lending arrangements with smaller NBFCs who are there in the personal loan segment, in which case we apply a credit policy of our own, right? For that limited purpose, right? Whereby we apply parameters on bureau score, ticket size, tenure, interest rates, geography, etc., right? So in reality, we are not in that business except as a co-lender in some cases. So it's not very significant, and therefore, we will not be able to comment a little too much on the personal loan space, right? Our own due diligence process and how it is different from competition, as I outlined, we go into a very high level of detail on the digital footprint as well as the physical diligence. We have not seen other lenders follow this degree of diligence, or both desk or in person. Having said that, I cannot really comment on what our competition does, but I can only comment on what we do and how well we do it. In terms of what is the second part, Ajay, after this?
After this, it was like, may you please elaborate the credit culture as to what is the team structure, categorization of the loans, like other people like HDFC Bank is categorizing is like A1, A2, A3 till A10.
Yes, good questions all. So back in the day in 2017, 2018 itself, we set up our own internal rating model, which we use to this day. So any company we onboard gets rated on our model, right? We don't rely on external ratings at all. So each and every client is therefore rated across rating scale, ranging from double B to double A on our model. These ratings are refreshed every single quarter. Now we have broadly three teams that are engaging with the client. The first is the business team, which is relationship managers. The second is the credit team, and the third is the risk team. Right? The credit team is in charge of conducting a high quality diligence, for which they are joined by the risk team. They also maintain a very strong data repository on the client. They also would do a quarterly engagement with all clients on a quarterly basis and re-rate all clients every quarter on our portfolio. Right? The risk team focuses on the bottom 10% troublemakers, where there could be potential challenges to recovery, and starts focusing on them on a monthly basis to maintain a very tight contact and control on the conduct of the account. Right? The business team is responsible for negotiating the best possible terms for ourselves, get the best possible security package, and also safeguard our revenue. Right? And as well as having strong client engagement. Finally, in our organization, given that we are a mid-corporate lender and not retail, we've ensured that the business team also remains responsible for collection. Right? So that because collection in the context of corporate lending is a very nuanced affair which requires a strong relationship as well, and hence the business team remains responsible for collection. Right? Diligence is only carried out by one member of credit and one member of risk. Right? So that the quality of the diligence is maintained, specialization is maintained, speed is also maintained, and the business team is left free to originate new business and to get the best possible terms negotiated. Right? So using this verticalized approach, business, credit, risk, we have tried to build a very strong credit culture in the organization, with the business team also being incentivized to maintain revenue and therefore not see portfolio losses. I hope that answers your question. As I said, from a rating perspective, absolutely we rate each and every company and maintain that rating as long as we have an exposure to them.
Right. The other question is about NPA, and what is the NPA for this 3 months end? It's basically for the March end, after March, June end. And what is the allocation ratio in the issue of HNI in retail?
The allocation ratio in HNI is 30% and retail is 30% out of a total issue of 500 crores, including green shoe. The NPA of the company as of the end of June is just a little over 0.5%. At a gross level.
Yeah. The next question is about what's the average ticket size for lending and why the cost of borrowing is low compared to the peers.
Yeah. So the average ticket size for lending is 3.5 crores. As I said, our lending is composed of co-lending, is supply chain finance lending and corporate lending. Respectively, the averages are in the range of 1 lakh, 1 crore and 15 crores. But for the company as a whole, the average stands at approximately 3.5 crores. Right? Our cost of borrowing has been controlled for the following reasons. One, we have remained well capitalized, so lenders see a significant factor of safety. Two, we have had very steady gross NPA. Gross NPA for the last 3 financial years was 0.3, 0.3 and 0.3%. And that has enthused lenders towards lending to us. Third is that we've also gone very deep in terms of access to debt across a wide array of market players. Today, a very large number of banks lend to Vivriti, plus NBFCs, plus mutual funds, plus HNIs. So we have tapped into a wide sources of capital, which has also helped us keep our cost of borrowing low. So I would say these are the 3 reasons why our cost of borrowing is quite low.
Right. So one question is about our intent to keep assessing the retail bond market on a periodically in future also, or is this a one-time exercise? We are the first time coming to the market to do a bond issue.
It's our first time, but by no means the last time. I think if we like this experience and see a good and healthy outcome for the first issuance, there's no reason why we will not keep coming back. For me, liability diversification is extremely important, and retail and HNI is a core part of that expansion increase of the diversification plan.
Perfect. This was the last question. And dear friends, as we have heard and seen the attractiveness in the offering of the Vivriti public issue of NCDs, may I now request your wholehearted support by reaching out to the segment of the investors class, especially the retail ones and individual categories of the investors. There are attractive options and incentives to distribution and shall be conveyed to by the consortium members. You may reach out to the issuer, lead managers, or consortium members for any information or clarification regarding the offering. That's from our side. Thank you.
Thanks, everyone.
Thank you.
Thank you so much. Thank you. Yeah.